So Solyndra got $500 million in a guaranteed loan from the Department of Energy, and Solyndra went very bad, and it became sort of the modern Concord example of, people saying, oh, government's such a basket case, why did they even bother investing in that company? Government doesn't know how to invest, it should have just facilitated, background conditions, don't actually make choices, don't pick winners. Forgetting that, well, they also picked Tesla. They also picked, of course, the Google algorithm funded by the National Science Foundation. I am Mariana Mazzucato. I'm a professor at University College London. My title is Professor of Innovation and Public Value, and I've just set up an institute at UCL called the Institute for Innovation and Public Purpose. What we tried to do in Rethinking Capitalism, which was actually a co-edited book, was to look at different problems in the economy and look at how they actually relate also to the theoretical process that has tied into the policymaking process. So we should remember Keynes when he said that practitioners who think they're on the ground just kind of doing stuff, doing good or bad things on the ground in terms of economic policy, they're actually slaves of defunct economic theory. And what we tried to do was to unveil this problematic economic theory, which has actually guided the policymaking process. So this idea that you wait for something to go wrong to then fix it, to put bandages, this notion that the market sometimes goes wrong and it causes market failures, so the policymaking process is just fixing market failures, is the key point that we tried to debunk. And we looked at problems of inequality, problems of climate change, problem of secular stagnation as a problem of the lack of a real market shaping and market creation process, and a lack of a better deal between public, private, and also third sector and civil society. So how to reshape those relationships, but beginning with a different way to view political economy as co-creating and co-shaping markets is what we tried to get across in the book. So in my book, The Entrepreneurial State, which I published in 2013, what I started out with was arguing that we have a discursive problem. How we actually talk about the state is a problem. And we get a self-fulfilling prophecy, where if we just talk about the public policy as fixing market failures, as leveling the playing field, as de-risking the risk takers, as enabling and facilitating, that also affects who wants to work in government. It also affects the degree of confidence of civil servants when they're then negotiating contracts. And we shouldn't forget that things like patents are contracts that need to be negotiated. And so if you actually look at the history of technological change for the last 200 years, and we shouldn't forget that capitalism is actually different from feudalism precisely due to the amount of technological change. We had 500 years of inertia under feudalism. So looking at the history of capitalism and the role that innovation has played in that process, you actually find that different types of public actors, this is not the state top-down, but different types of public actors have actually played a very important role as an investor of first resort. And even that term, if you think about it, we are accustomed to thinking of lender of last resort. And so all these really kind of lame and boring and backseat player terms that we use for public policy affect, again, who wants to work in public policy, the confidence of the public policymakers, the types of deals that are struck, but also the willingness to actually be bold, to be mission-oriented, to even have a vision. And without a vision, in the public sector, we wouldn't have the internet, we wouldn't have GPS, we wouldn't have Siri, we wouldn't have touchscreen display, all sorts of technologies inside our smart products today. But we also, and this is a key point, will not have a green revolution. And there's lots of talk out there about the need to direct growth in a different way. We talk about inclusive growth, smart growth, which is innovation-led growth, and sustainable growth, so green growth. But that's all about directionality. And so one of my key points is that in order to have directed growth, which actually achieves those very ambitious challenges, we need to rethink the role of public policy in terms of, again, investor first resort, boldness, being mission-oriented, and also really think through also the organizational capacity and competence that's required inside the public sector. And so part of this problem, this self-fulfilling prophecy that I've mentioned, which is that when we talk about the state in a certain way, it sort of becomes that way, that's also, I think, one of the lead reasons, or if you want, one of the causes of that has also been public choice theory and new public management, which has taught civil servants in some ways to fear government failures, even more than market failures, and has also introduced pretty static cost-benefit types of efficiency metrics inside the public sector. We would have never had the internet had we used cost-benefit analysis, and we won't solve climate change with cost-benefit analysis. So one of the key things I'm trying to do in this new institute that I've set up at UCL, which is called Institute for Innovation and Public Purpose, is actually to think through, what should we be teaching policymakers and civil servants? What should a master's in public administration be thinking about in terms of encouraging the public sector actually to take the risks, to explore, to experiment, to not worry too much about failing, but definitely learning from those failures and investing in those kinds of capabilities and competencies that make public organizations a learning organization, exactly what we have business schools for the private sector. Innovation, first of all, is a very collective process. There's lots of different actors. I've been talking, and I've talked a lot about the role of public actors, but of course there's also private actors. There's different types of private actors, small firms, medium firms, large firms. There's also organizations in civil society. So the welfare state itself was an innovation. The 8-hour workday was a great social innovation fought for by trade unions. So if you think about innovation in terms of structural change, change that really helps to co-create and co-shape markets, new types of markets, we have to, in the first instance, admit that there's different, types of actors. Now, we can talk about institutional innovations, we can talk about organizational innovation, technological innovation. I believe that actually all three of those, so technological, organizational, and institutional, and social, are extremely important. But if we just focus a minute on technological change, which is usually what people think about, the first thing to admit is it takes a very long time. So if you want very quick returns, you're going to have a problem. And you're also going to have a problem if you think it's going to be a linear process. You just put some money here, and then at some point you get, say, commercialization. So it's a nonlinear process, it takes a very long time, and it's a collective process. And those three characteristics really very much define the innovation process, but it's also a process that eventually might bear quite a bit of fruit and also money. And what I think we lack today is that by not talking about innovation as a collective process, the rewards to the innovation have often been distributed in a much more narrow way than the risk-taking was distributed. And I was influenced by both Marx and Schumpeter on the emphasis they placed on technological change as being one of the key drivers of growth under capitalism, but also its role, especially when you read Schumpeter, in causing constant differences between the actors themselves. If you're competing and trying to increase your market share through innovation, you're constantly differentiating yourself. And it's incredible then that neoclassical economic theory, which is still taught across the world, which has some good points in it, but one of the key features of it is this emphasis on the representative agent, on unique equilibria, and of course there are differences, but they tend to be differences that are sort of transient states towards some sort of equilibria. And even though, of course, there's an admission that you don't have perfect competition in microeconomic theory, the fact that the benchmark model remains one of perfectly competitive markets, and to talk about realistic markets, we have to look at some sort of distance from this framework that we call perfect competition, should be the other way around. So if you take Marx and Schumpeter seriously, that innovation is a key driver of competition and differentiation between firms, then that process of differentiation should be at the center of how we look at competition. And it's quite striking, actually, then in the policymaking process, when we look at sort of antitrust and competition policy and state aid rules, say in Europe, how we don't actually have a competition theory to drive competition policy that really embodies how innovation comes about. So if innovation requires patient, strategic, long-term committed finance, and if that finance tends to be mainly coming through different types of public finance, whether it's the Chinese Development Bank, the KfW, YOSMA in Israel, DARPA in the US, the SBIR program in the US, then we better make sure that then we don't call these patient, strategic, public sources of finance, anti-competitive. And that sort of matching up of a discourse in economics on sort of production, innovation, long-term growth, and how we should be thinking about competition, that's a huge area, I think, that actually researchers in INET should be looking at, because we need to bring together innovation policy and competition policy and growth policy. One of the things that I've been arguing is that, for example, when we think about innovation policy and industrial policy, we should not be thinking about sectors or even technology. We should be thinking about problems. So whether it's going to the moon in the past, or thinking about, reducing the material content of industries in order to solve the climate change problem today, these are huge problems actually that require lots of different types of sectors and actors across the economy to think about together. In fact, going to the moon required more than 10 different sectors, including clothing. It wasn't just an aerospace problem. And so one of the questions that arises by this, and I would call this mission-oriented thinking. What is the mission, what is the plan, and how do you use that really to drive innovation policy is, well, who should think up the mission? Is this a top-down president? It was President Kennedy and his team that thought about going to the moon? Or is it a more democratic process? Is it a peer-reviewed scientific process? And I don't necessarily have the answer to it, but by first admitting that innovation doesn't just have a rate, but a direction, and by the way, economic growth as well doesn't just have a rate, but a direction. This question about directionality and how do we learn to debate that directionality and not pretend that actually what the state should be doing is just facilitating, again, think about the framework condition and then let the direction happen in this thing called the market, forgetting that the market itself is an outcome of public, private, third sector interactions. That's a really sort of key point. And also this worry that governments shouldn't pick winners. Well, governments have to pick. They have to make strategic choices. They have to have deliberation and consciousness how to do that in order to both provide a direction, but at the same time really enable bottom-up experimentation, exploration, creativity. That's the challenge. And I would argue that by actually, no country, I think, has necessarily gotten this perfectly right. It's not about copy and pasting what happened in Silicon Valley, in Europe and China or in Africa, but actually learning about what happened within also organizations in the public sector, whether it was DARPA, whether it's an innovation fund today in the European Investment Bank, whether it's the kind of democratic processes in Germany that led to green becoming an agenda that had legitimacy in the country, which then enabled the Energiewende policy to come about, right? So Energiewende in Germany today, I would argue, is a real mission. It's a mission across many different sectors. It's not just about renewable energy. It's helped steel, kind of a boring old tech industry, to rethink itself. So steel in Germany, unlike steel, say, in the UK, has massively lowered its material content through repurpose, reuse, and recycle. So this mission-oriented agenda, which across different sectors in an economy causes these sectors to rethink themselves, might be happening top-down, but where those decisions come from to even have an Energiewende policy. In Germany, it was quite interesting that it came after decades of a movement in civil society that was fighting for this green direction. And I think this is the issue. Where do missions come from? Is it a dictator? Is it a president? Is it a civil society movement? Is it a scientific process? And I think we have lots to learn by even just taking inventory and mapping that process across the world on what worked, what didn't, and also what did it mean for the kind of capacity building within the organizations that were involved. By admitting that innovation is a collective process, it's a social process, we have to be careful to not just socialize the risks, but also the rewards. And how to do that is the question. And I've actually been thinking quite concretely on how that might be done. And the first thing is to admit that even the profits that are generated, so the profits at the end of the dot-com revolution, the profits after the biotech sector came about, which was after decades of National Institutes of Health's investments as investors of first resort, even before the biotech companies came about, before the venture capitalists came about, those profits in some ways you could see them as having been collectively generated. So the first instance, or I would say the first priority, is to make sure those profits are also reinvested back in to the real economy and not, for example, financialized or not hoarded. And these share buybacks, for example, that people like Bill Izonik, through an INET grant, studied, which is the degree to which companies increasingly have used their profits just to buy back their shares, to boost stock prices, stock options, and executive pay. That's a reinvestment problem. But I see that also as a failure for the public, which has been a huge contributor to the wealth created in the pharmaceutical companies, in the energy companies, to have also negotiated sort of the terms of being able to benefit from that public investment. And by the way, the largest share buybackers are in fact in pharmaceuticals and energy. And we shouldn't forget that patents themselves are government-granted monopolies for 20 years. It's not granted from God. And so the fact that we have increasingly seen patents being taken out upstream in the innovation process so that the tools for research themselves are being patented, which is a problem. You shouldn't be blocking the scientific process. You should be just patenting the downstream results of that. That itself is a failure of the public to properly negotiate the rewards back to the public sector. So when you have a deal, public and private with a patent, the reward for the public should be increased diffusion once the patent is up. But if in the meantime you've patented the tools, the scientific process itself, you've actually blocked innovation. Or I often give the example of Tesla and Solyndra, two companies that equally benefited from early stage investments from the taxpayer, right? So Solyndra got $500 million in a guaranteed loan from the Department of Energy, and Tesla, I think it was $465 million, very similar amounts. And Solyndra went very bad, and it became sort of the modern Concord example of people saying, "Oh, government's such a basket case. Why did they even bother investing in that company? Government doesn't know how to invest. It should have just facilitated. Background conditions don't actually make choices. Don't pick winners." Forgetting that, well, they also picked Tesla. They also picked, of course, the Google algorithm funded by the National Science Foundation. Forget who's actually doing this stuff, but these are public funds, right? And so by actually admitting that you have, some wins, some losses, something that entrepreneurs love to brag about, that they were willing to, take some losses as long as they get that big win later, this should also be a lesson, I think, for governments on how both to market themselves a bit better. How many people know that Tesla was, financed in the early stage by the DOE, or that the internet GPS Siri touchscreen were, but also to actually structure it properly as a portfolio. Some people don't like this recommendation of mine, but I continue to make it, which is why not take out some equity in those investments? In fact, Obama, interestingly, did think about that, but did it in reverse. He said, if Tesla doesn't pay back the loan, we get 3 million shares in the company. The question is, why would you want 3 million shares in a company that doesn't pay back the loan? It's probably not paying back the loan because it wasn't successful. Had he done the opposite, we get 3 million shares if you are successful and pay back the loan. The price per share went from 9 to 90 between 2009 and 2013. Multiply 3 million by that difference, it would have more than paid off the Solyndra loss and the next round of investments. Exactly how a VC would think about it. But having said that, we should be careful because you don't want the public sector also thinking like a VC. VCs are often short-termist. They want, again, as I mentioned before, they're exit-driven. They want their returns in 3 to 5 years through a buyout or an IPO. So the real challenge for government is to remain mission-oriented, think about the big problems in society, but also admit it'll be difficult. You will have to make some choices. And if you trip along the way, make sure your citizens understand that that's part of the process, but when you make the successes, make sure you structure those investments so that you do, allow the citizens themselves to benefit. And whether this is through reinvestment conditions, IPR conditions, prices, why don't the prices of drugs reflect this huge public investment? So the taxpayer ends up paying twice. Whether it's through equity deals in the downstream investments. You don't want to take out equity in sort of basic research, right? You should allow the spillovers to happen. But these downstream Tesla, Solyndra kind of investments, how to do that is up to the particular city, regional, or national government. But you won't even ask that question about socializing risks and rewards unless you've first admitted that what the public has actually provided is that lead investment, high risk, early stage, investor first resort investment, and the public has created value, hasn't just redistributed, hasn't just leveled the playing field.